Okay, another trading day. Actually got in a trade first thing this morning. We were trending up, and I actually got in a trade after this break here. I got in on this light rejection here. Lesson actually learned would be, it's very risky to trade within the first 15 minutes of market opening. So it's best to really, really know whether it's a ongoing trend that was already on the moving end, or you were looking to do a trade that may have been a swing trade. It was going to last a little bit longer, and you knew that your entry was what your entry was. But as you see, the entangled EMAs are a sign to kind of bow to the side and wait to see what happens. When they're braided like this, it's always best to kind of wait to kind of see what happens. So I saw the feathering out occurring here, but when it occurred, you're still close to the uh, pre-market high, which was right here. Pre-market high, give or take, right here. So as you see, broke in, kind of consolidated here. I got in on the rejection of, even if you're using orb, your orb candle, first 5 minute opening candle, breaks above, actually comes back and retests. So it kind of, did a little bit of a fake out because as you see, it went down, but then it continued up again. So I got in here on this rejection and kind of was got caught up in this, and then I took a little bit of a loss, but and then I got in when it was actually against me. It was like ill advised for me to get in. I shouldn't have gotten in when I did. So another lesson learned. I said, hey, wait a minute, that's a rejection, but based on my rules, I shouldn't have gotten in on this play, and I did it anyway. So uh already oversold. That's another thing we see here. The RSI is already in the oversold area as well. So when it got up here and kind of started consolidating after I got in, it did a drop. I immediately let it take me out, hit my stop loss. And as you see, it broke down below the 9 and 20, and then broke back, retested here. I actually got in on an entry right here, and I caught this move down to the pre-market low. It was like actually uh, it was a gap that needed to be filled that I knew of ahead of time, which technically that could have been seen as a break, as a fake out as well, because it didn't fill the entire gap. It still hadn't filled it. It doesn't mean it's not going to come back and fill it. But there was a little bit of a gap this morning, and it did break back down. Caught the trade coming back down, took profit. So the loss here that incurred, I actually earned, got that loss back and some based off this move right here. It doesn't take a big move. As long as you're limiting, what I'm learning, limiting the number of trading that you're doing, going in, not over trading. I've cut back to under 4 trades a day. So under no circumstance will I ever go over 4. And under a lot of circumstances, I don't even go over 2. So if I come in and I make that first decision and I'm out of there in a loss. If I had taken another loss, of course, it wouldn't have been any chance for me to get back in again. But my second time, I got a win. So I profited on this move. I could have waited through a little bit of this consolidation. I would have gotten the sign, the entry right here, where you see it's breaking back above the 9 and the 20. Retest here. This is a good candle on that little rejection. I could have gotten back in if I was still uncertain. You see here it came back like as if it's going to do a pullback. Retested it again right at the cross. When I say the cross, it's when the blue line is crossing back above the yellow line, which the yellow line is the 20 EMA, blue line is the 9 EMA, and the 5 EMA is the green. So when you have this extended looking like this is considered to be slightly an early entry because you still have the yellow, which is the 20 working its way under. But an active uptrend has your 20 underneath, 9 on top, 5 on top, and then active downtrend, as you see here, you have your 20 on top, 9 on bottom, and 5, which is the green underneath that one. So we're all above the 20 EMA. So I'm sorry, the 200 EMA, which is this big, thick pink line. And under that 20, the 200 EMA, active puts, active shorts. Above it is active calls. So typically what I did, which going back to how I broke my rule, is I don't get in for a call or a put this far away from that 200. This is a sign that this big gap is a sign that eventually you're going to get a pullback that's going to bring you right back to that 20. And if there's going to be a continuation upward, it will reject that. I'm sorry, the 200 actually. It will reject this 200 EMA and it will continue upward. Or it will break the 200 EMA and continue downward. Either way, I got the move here. It had a choice to either continue downward, which you continue to ride it, or you can wait for a break back above the 20 and get out of it if you're trying to ride the trend just to see how far to go. I took profit at a take profit, which was here. I purposely took the take profit at the 200 because it's like a magnet. It's known to draw back in price, and it's known to either bounce off of it and continue in its intended direction or break below it. So that's just what, so that's why I go back to me getting in this trade right here, being this far above, knowing that, hey, uh, you know, we're going to be probably getting a pullback and it's probably not going to continue this way all the way up before pulling back and then continuing up, just based on what I've been seeing with SPY trading it all this time. It's not an end all be all, but it's a lot of times the way it goes. I mean, a lot of times. So yeah, we ended in profit. Uh, uh, so no break even. There was actually a nice little profit made on this move to making up for this loss coming back down here. Minutes, the win was good here to where I shut down for the day. But as you can see, 5, 10, 15, 20, let's see, roughly about an hour after I got out, my system gave me a call uptrend for a long, and it was an even bigger move, as you see. It went on up there, and that was a pretty big move that I did not take advantage of, but I was done, which I could have. Because like I say, I don't do more than 4 trades. I was only at 2 and I was up on the win. So when I got that call, when I got that long call based on me seeing my, break above the 9 and the 20 and then come back and then retesting it right here. Hey, there we go. But like I say, you're not going to catch every move. And a lot of times, like I say, the best thing to do is take the moves and use minimum of 2 contracts to split positions. So you have one maybe where you have first take profit, maybe right at the pre-market high, or because we already traveled and went and dealt with the pre-market high, you could have gone to the next level above here to take advantage of it all the way into the end. As you see, it never broke below the 200. So even following that trend and not getting out until it broke the 20, I mean, hey, it never broke the 20 until pre-market. But I don't swing trade SPY. Not right now. I'm not swing trading SPY right now. But if anything, I would have gotten out, give or take, right around here towards the end of the market. I would have already been out. Or if it was a 0 day, a 0 day option, which means it expires same day, I would have gotten out sometimes around maybe 2 o'clock, right before two, because that theta would have been, getting eaten up, heavily. That's why it's a good idea to do, if you're able to do next day options, you have more room to where if you want to take your trade out at the end or right up to the end of the day, you don't have to worry about any type of theta repercussions, and you can make all that move up there if you're following the trend. Only if you're following the trend, it's easy to kind of see how you can do that. And I do use uh the 2 minute as an extra uh extra kind of just kind of lets me kind of see early what's happening. And even in that, you don't have a break below the 20 until it breaks down here, moving stop loss right here. Once it breaks down, that's typically how I do follow a trend. Once it breaks out of the, on the 2 minute, if it breaks out of the uh 20 EMA, I would have moved my stop loss, give or take, right here, let it keep going if it was going to keep going. And as you see, it did. And then once it would have broken back down here, that would have prompted me to move it up some more. So that's how I follow the trend. Move it up here. Uh, Based on what I've seen, it probably wouldn't have got taken out of right here. That wick down, it's a hit and miss if I would have gotten taken out the trade. But if it would have, heck, I'm at the pretty close to the end of the day. I probably would have gone ahead and taken profits after moving in there. But that's just an idea of what I typically do when I'm following the trend versus when I'm just hitting a designated take profit. And on this move right here, would have been a perfect idea of just letting it run to see what it was going to do, since I was already up in profit. And once I came and cleared this in, I would have let it roll just to see. But that was it for this particular trading day.